Welcome everybody to a very special edition, a Thursday breaking news edition of the Not Your Average Investor Show. The Fed finally did it. They dropped rates further than we expected originally, and everybody is all hullabaloo around it. But around here, we got a couple of guys that have been talking about the effects of this, what's going to happen, and there is no surprise happening. So stay tuned for a great episode. Chime in the chat. Let us know you're here. My name is Pablo Gonzalez. I am the host of the Not Your Average Investor Show. With me, as always, the guy that I affectionately like to call GC because he's got the genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you today.
And a kindred spirit in our quest here to show the benefits of real estate, a man who has done thousands of these real estate deals, finance expert, somebody that marches to the beat of their own drum. Definitely not your average finance guy out there, which is why he's so welcome on our platform. Aaron Chapman, welcome to the show, my friend.
Thank you. I appreciate you guys letting me on and allowing me to speak to the audience and drag some of my own. Because, like you said, there's some contrarians on here with us.
Yeah, we are two communities that do not like to take the average stance and just make it our own unless it makes sense. So welcome to all of you that are coming from Aaron's community. We got a little tradition in our community when we kick these things off. GC, what's that tradition called?
Called the roll call, baby.
The roll call, baby. We got the Lee Bishop, the MVP, Lee Bishop, kicking us off. You're saying hello, everybody. We got the mystery man, Denny Davis, with a woo pig suey. Denny, I'm not going to put my heart into that one. Joanna, our community manager's in the chat. If you need anything, let her know. Milady, Jack Chadha checking in. Good to have you. We got the fairy godmother of the Not Your Average Investor Show community, Jen Filson from Monterey, California. Good to have you, Jen. The early bird of our community, Dean Curry, checking in from Columbus, Ohio. We got Big Papa in the house. We love it when he calls him Big Papa. Jay Cohen, the co-founder of JWB, Greg's dad, Jay. Good to have you, my friend. Christian Mercer, live from Costa Rica. Pura vida, Christian Mercer. Good to have you. We got Reggie Fonseca from the Inland Empire. Reggie, good to have you with us today. Brianna Stamps, I think that's one of your fans with a woo, Aaron. Brianna, good to have you here. Hope you join our community, make a friend here in the chat. Would love to make it a tradition. We do this live every Tuesday at this same exact time, 12:30 Eastern, 9:30 Pacific. I know that y'all got both sides of the equation here, and I know that you live in Mountain Time and West Coast time, and you got a heavy West Coast contingency. But here at the Not Your Average Investor Show, we got fans from all over the world as well, Costa Rica to Spain, and people take us with us. So happy to have you here. And I'm just going to kick it off with the topic du jour. That's what we call the topic of the day around here. Timely announcement from the Fed yesterday. They've been teasing this rate drop for multiple Fed meetings. We thought originally it was going to be a 0.25% drop. They ended up dropping it 0.5. Right. So, Aaron, I know that this is something near and dear to your heart. Why don't you let us know what you're thinking about this announcement and how it's affecting the way that you're going to proceed?
So, of course, this is the one thing people keep talking about, the massive topic of discussion since the beginning of the year. Fed's going to drop it 5 times. I'm looking at it and say, guys, the way inflation's looking from my perspective, I didn't see it. I finally conceded in the last couple of months between myself and a guy named Patrick I come onto YouTube a lot with. I said, I'm going to see it. We're going to see it one time in September. So we saw it one time so far. He's claiming 2 or 3 times. We'll see how it ends up in the year. Ultimately, it didn't really have as big market movement everybody anticipated. I'm getting all these phone calls. Fed just dropped the rate. Can I relock my loan? Can I cancel my lock and get another lock? Say, guys, it actually didn't affect the market whatsoever when it comes to mortgage-backed securities. It actually kind of made it a little bit worse. Now, why is that the case? Somebody say, that doesn't make any sense. The Fed just dropped the interest rates. Well, what is the Fed? The Fed is the bank of banks. All they did is say, hey, when you borrow money from us, Bank of America, Wells Fargo, Chase, and the other banks, you're going to pay less money to us than what you were before. Now, that's going to trickle down eventually into the market. But what does that also do? When money becomes cheap, people start spending money, right? Well, then it can be a slightly inflationary thing. We've had inflation continuing to push the dollar down in value, have an effect on our economy. They've kept it tight where it's finally started to recede. The Fed's been talking a lot about what's going to drive, what's going to make them make a move. It's going to be jobs. Well, now we're seeing jobs taking massive hits. And just in the last month, we had the information come out from the Bureau of Labor Statistics saying, hey, we miscalculated by 818,000 jobs. We were off by nearly 1 million jobs. And those million jobs that really didn't happen, and then you factor in the jobs that did happen, 50,000 per month were government jobs. What's really happening to our economy? And I personally believe, this is just Aaron Chapman, this is not coming from any other place, that Powell finally had somebody headlock Powell and said, you do this now. They wanted more, wanted 3/4, he did a half. He's always been the contrarian. That's happened, but let's just show you guys the effect of this. I'm going to show you the mortgage-backed security. I don't know if you guys are familiar with this. Pablo, have you seen it before? Greg, have you seen it?
Maybe. What do you got?
Okay, so I'm going to show you guys the actual mortgage-backed securities that show that basically dictate our interest rates. This is going to be what's called the 5.5 coupon. This is what I follow. So this right here references the value of this security as it trades minute by minute since back in back, I think it was May of 2008. We're going all the way back there. So this is that full security. This right here is trading before quantitative easing, the Fed actually injecting capital in the market to bring rates down in 2009. And everything above this line right here references the value of the security when the Federal Reserve is punching money into it. So the Federal Reserve started putting money in right here. This represents $8.9 trillion invested by the Fed until right here, which is the end of October 2021. And then the bottom falls out of it. Interest rates spike. So the reason I bring that into this point for people to see is this is where you go to see what's happening with the rates minute by minute. So I spend my time studying this. So this is right now. This is showing you today, this morning. This is the value of that particular security. I'm going to zoom in a little bit more for everybody to see it. This is 2 days ago. This is where the value was. The higher this goes, the lower the rates go. Why does that do that? This means money's flowing into this pool of funds for us to lend out. As it gets borrowed and taken out, it has to be resupplied with more investment capital. So more investment capital going in than what's going out will mean the rates will keep going down, supply and demand. As this drops, the rates will go up. So there's greater demand, less supply, the cost goes up, the rate goes up. Well, this was 2 days ago. This is yesterday. This is when the Fed announced, finally, we're going to drop the rate. The market anticipated a drop. Market hoped for 3/4, it got a half. But what we have is a decline. The market actually dropped down and it came back off of its lowest levels to be a positive day, but not a positive day as in the rates going down from the previous day. And this is today. Today we opened at a point, higher than where we closed yesterday, but we hit this particular line and bounced off it. Now I drew these lines in. This line is one I drew. This another line that I drew, and this I shaded in here for a specific reason. I'll get into that into a moment. And these right here are your what they call your trend lines. You got was it a 14-day moving average, a 21-day moving average, a 35-day moving average, a 100-day moving average, and then a 200-day moving average. So these are the averages of this security over any period of time. And traders will use that as a way to determine where they're going to invest, what's the trends going to be, should they put money in there, should they take it out, where do they think other investors are going to go. So this is important for us to look at this. Now this shade here, this is an interesting thing to understand. We have a support line here that I drawn, which actually was a ceiling for a very long time. And then another ceiling line that I drawn here, and I shaded it in for a specific reason. If you go back over the last few years, this takes us all the way back to when we bridged through this line in March of 2023. We went through this. Reason we broke down and we kept having this decline in the market, meaning interest rates going up. As these go down, rates go up. The reason we had this continued decline was the reporting of the jobs. So if you think back into 2023, we had our current administration talking about what they're doing for the American economy. They're creating jobs, millions of jobs for people. Look at all that we're doing for the economy. Then you get all the way to October of 2023, and it turns around. Why does it turn around? If you go back, that is when the Bureau of Labor Statistics starts coming out, and you have ADP, which is your payroll company, all coming out saying, wait a minute, this is not adding up. And then they start actually reporting there's a lot less jobs than what we thought. Sometimes these jobs are people having 2 and 3 jobs in one household, and they're part-time. Once that started coming out, the market started rocketing up saying, wait a minute, maybe it's not as inflationary as we believe. when it's not as inflationary, we're seeing a softening of the market, more money goes into bonds than it does into stocks. And we saw this rocket up. And what's interesting is it rocketed up to where? To that line that I drew. And it bounced off it, bounced off it, bounced off it. And I was guessing, way back here, I was guessing this is going to be a ceiling. It's going to be hard to get through. And why is that going? Why is that the case? Well, I'm going to advance us back to 2008. So after the crash of 2008, everybody's life went to hell, if you will. And then you have the market not wanting to invest into mortgage-backed securities. There was some going on. There's not a lot of people drawing on it. That's why it was even as high as it was in value up here, because not a lot of people borrowing, if you remember, after during that crash. So, and not a lot of money going into it either, but there was enough to sustain a specific value or enough volume within the pool. But then you have the Federal Reserve come out and say, we're going to start quantitative easing. So you got Ben Bernanke and Hank Paulson got together. Hank Paulson was the Secretary of the Treasury. Ben Bernanke was the chairman of the Fed, and they announced it to the world. So Pablo, Greg, let's just say we're at breakfast one day, really, really nice restaurant. Three guys come in suits, sitting next to us, and we hear them talking. We heard they're going to take their firm is going to drop $100 million into a specific stock. What is it you and I are going to do the second we leave that restaurant?
Buy.
We're calling our Schwab guy. It's like, buy this stock right now. So everything else go right here. They're dropping 100 million into it. That's what the Fed did when they announced this. Said we're going to take billions of dollars, if not trillions, and invest into mortgage-backed securities. The day they announced it, the market started here. It rocketed up as high as this level here, but receded back here. This was one full days of trading that the entire market decided to jump into this security because of what the Fed said they were planning to do. Then you move forward to January of 2009. This is the point where the Fed actually started investing money in from public capital. And then you get to the point of what we have here, which is the entire security there. So drawing your attention back to this full day's worth of trading, I drew the line at the bottom, the line at the top, and I shaded it all in. Fast forward to where we are today. And what do we have? That full day's worth of trading is what's going on right here. These are our ceilings and our floors. I think we're going to be trading sideways for a while. Why would I say we're going to trade sideways in this for a little while? Some people say, hey, rates are going to go down. We think they're going to go down. They go back to 3% or 2% like they were because the market moves in cycles. And my lender says it moves in five-year cycles. Most lenders in my space that do what I do, I'm a mortgage guy. I get people loans for 30-year fixed on a house or duplex, triplex, fourplex, even bigger units than that. We do it for your DSCR loans, your conventional loans. A lot of people buying houses as investors, they're talking to guys who've been doing it for the last 5 to 10 years. This, all that I just showed you, has been happening for the last 15 years. So if they've been in it for 5 or 10 years, they've never really seen a cycle. I got this in 1997. You guys know what the conforming loan limit is, correct?
Yeah, before a jumbo loan.
Yeah, that's the max you can get as a conforming lender. Do you know what the conforming loan limit was when I got in the business? It was about 212,000. What's it today? It's over 800 grand. 800,000. Look at that big difference that's happened. So you want to talk about cycles? I was present. I watched the guys from Schwab in my same building running up and down the hallways with their shirts off because the Dow broke 10,000. We broke 40,000 this year. There's so much difference when it's going on in the market. So when people tell me, oh, my mortgage guy says it's going to do this, they've never seen a cycle. There's a lot of guys not in the industry that understands this anymore. So I think it's really imperative to help people really get to know what's happening in the market, what's driving this. So to get right back here to show you the chart real quick, and we'll spitball some things together. So again, I believe we're going sideways in this channel. That means interest rates are going to stay that direction. Now, does it mean I'm right? No, it can change. We're living in a world right now where our federal government does stupid crap all the time. And they're going to do something that's going to drive things to make people think that they are doing something to help them, and we're going to vote for them. We have this other ceiling we can go to. This ceiling here I drew as the next level where I believe that we would have a massive hard stop, which is the day the Fed actually invested money into the bond pools. So we have that window of time. I think it's going to be hard to get there. I think we're going to need to have a significant market crash. That's what happened here on August 2nd, over 1,000 points of movement to the negative in the stocks. Where did that money go to? It went to bonds. And we saw it rocket up there right to that level and then right back down. So that's what I want people to really get a good grasp on, is what really drives interest rates. It's not the Fed. It's not them dropping the rates. It's not all these other things that people think of. It's not the 10-year. It has to do with the mortgage-backed securities. Now I'm seeing Lee Bishop ask here, what does the 102.61 amount to? That's the price of the security, right? So I look at these values. There's par and there's a par value of 100, which is what we just broke past. That 102.61 just says that's that particular value of that security. We'll probably move to a different bond pool if we go to that point. It gets there, we're going to move to a 5% coupon or a 5. So we will see rates go lower. To be able to define that takes a lot of time, and Pablo gave me windows of time today. So to get into the definitions of that stuff, it really doesn't matter a lot for what we're going on here. And I know that Pablo says, nope, we have to keep it here to 2020 and 20.
You're not supposed to show people the magic behind the curtain, Aaron. Sorry, man. Listen, what I love about everything that you just shared, that we talk a lot about on the show, is that data alone is not enough. It's data plus perspective. This idea of talking to folks like you that have been in this for multiple cycles. Greg, you're a guy that got into this multiple cycles ago too, doing it 18 years ago, have built a company that manages over $1 billion in assets, 6,000 properties, fully vertically integrated, been on the front page of the Wall Street Journal a couple of times. I'm not as smart as you with everything Aaron told me. Like, I think I intuitively get it, but I kind of need you to translate for me. You know, like, what am I, as a real estate investor, what am I looking at here?
Well, first of all, what a cool insight that most of us have never actually seen. Most of us fail to understand that on the other side of a mortgage that we're paying interest to, there's an investor on the other side who's actually putting their money and requiring a return on investment. Many people don't realize that. And that is a major takeaway from what Aaron is sharing here. He's also giving some really detailed technical analysis here, which is super helpful for a lender to actually know this stuff. I've talked to a lot of lenders in my day, Aaron. I got to tell you, I don't think any of them are looking at the same stuff you're looking at. So I think it's a really wonderful kind of peek behind the curtain. And I really love how you said most lenders have never been in a cycle. Most lenders have never been in an interest rate environment like we are in today. And most investors have never been through a cycle. And most investors have never been in an interest rate environment like we have today. So I'm going to take the approach of, okay, now that we have an understanding of how interest rates actually work a little bit more, and we have some clear markers that interest rates are going to go down in the near term and over the long term. What does that mean for us as investors? And I'll just keep it really simple. What we know is that when interest rates go down, asset values go up. When interest rates go down, asset values go up. And the reason is because the costs of borrowing go down, so your cost of owning that asset go down. So inherently, somebody can pay more for that asset and still get the same return on investment. And so if you think about that and think about where you're placing your dollars today, can really help you take advantage, because right now is such a special time. Just like Aaron was talking about, most people haven't been in this interest rate environment. Well, if I start to think about rental properties now, which is my love, which is what we've built our business off of. In rental properties, when interest rates go down, home values go up. When interest rates go down, home values go up. So if you understand this relationship, you can start to make well-educated decisions and buy those assets before the home values go up. And you're going to find that a lot of people are stacking a lot of equity gains that other people are not, because of just simply understanding this relationship. And it's the only time where we have had interest rates this high and the Fed has signaled this strong that they're about to go down. We don't know exactly how much and how far and all that good stuff, but when you have that indication, this is an opportunity for us as not your average investors to do something about it and to take serious steps forward for your financial gains.
It's really good you point out the relationship between interest rates and costs of things that people don't quite understand. Your average human being that's not spending time in their morning to be on a show like this or talk to people like ourselves and dig deep into the understanding of things, they're sitting on the sidelines waiting for the interest rate to drop to be the perfect time. And what we've noticed, and what we do know for a fact, if for every 1% we drop in interest rates, you're going to see a 10 to 12% increase in the asset. So the rate drop in reality, guys, is not an improvement to your overall outcome. It's actually a way to drive value up to the people who already have it. So the people who, if you're thinking about this like a football game, and if you're going to conserve your energy and you're going to sit on the sidelines, you're going to wait to that perfect moment to jump on the field to get on the highlight reel, guess what? You're going to miss that opportunity because the people who are on the highlight reel are already on the field. And if you're in the top of the stands, you're never going to make it to the field. You're going to get trampled. You're going to not only lose out, you're probably going to get yourself stomped. The other thing that people don't quite understand is that when you're waiting in these things and wanting something else to do it for you, that you truly don't even understand real estate investment. You're not an investor. So we're going to break some stuff down. We're going to, myself, Pablo, you're going to do some math, brother. Hopefully you're ready to do this because I'm going to show people how interest rates really do not matter. What it does do is it, again, drives up the value of your asset. Think back when interest rates are 2 to 2.5%. Your average realtor was saying, be prepared to offer 30 to 50,000 over list just to be considered. And then it's possible to pay $100,000 over list just to get the house. Did a 2.5% rate help you when you pay $100,000 out of your pocket to get that asset? No, you prepaid for the rate. Either way, you're still paying for it. So, Pablo, ready to go here? We're going to do something. We're going to do something
I love public math, brother, and I love what you're talking about. We've been talking about this idea of you get in before the rate goes down. That's when you lock in that appreciation and you refinance later as you do this. So I can't wait for you to illustrate it, man. Hell yeah.
I'm going to show you how refinancing. When you refinance, I advocate only to pull cash out and reinvest, not for the interest rates, and I will show you guys why. So Pablo's going to do math. Greg's going to test him and make sure he's doing it right, and the rest of you are going to make sure these guys are doing it right. So everybody, get your phones out, get your calculators out. Now we're going to talk about an average property you might see coming through a JWB pipeline, if you will. So we're going to set some baselines. $200,000 purchase price, and we're going to actually kind of beat it up a little bit. We're going to talk about a 20% down, less down, because that's going to give you a higher interest rate. And we're going to talk about a 30-year fixed loan. We're going to talk about a $1,800 a month rent with only $100 a month in cash flow. Does that sound sexy to anybody?
Oh, it does to our community for sure, bro.
So YouTube, yes. There's people that I share that with. I'm like, nope, I'll walk away from that. $100 a month cash flow on a $200,000 asset. No way. Yeah. Well, I'm going to show you why this is extremely sexy. Now, a lot of people, especially in this community, 25% down is, in fact, we'll even do it with that. Let's just do it with that. 25% down. We'll do the math together. So we're going to talk about a $200,000 asset, 25% down. What is 25% of 200,000?
50 grand.
$50,000.
Yeah.
So with that 50,000, what do you get in the form of a loan amount?
$150,000.
$150,000 loan. So you have one job basically, and we're saying, let's say there's about $10,000 in lender in total fees, lender, title, appraisal, taxes, insurance. So you're investing $60,000 for a $150,000 loan. The sole job you have as a real estate investor is to find a home you can keep reasonably rented the entire time you own it. You have the ability to raise rents and it can appreciate. That's your job. If you did that, who pays off the $150,000 loan?
The resident.
The resident. So it'll be a group of tenants over 30 years. So let's take that 150,000 divided by 30. What number do you get?
150,000 divided by 35.
You get $5,000. That's $5,000 per year. And how much did you invest in the house?
50.
Plus costs?
Yeah, 58, 60. I don't know.
$60,000. So when
how am I doing? I feel like I'm doing pretty good out here. I don't have a calculator in front of me, folks.
You're supposed to. I warned you. Yeah. So what is 5,000 is what percentage of 60,000? It's 8.3%. So that means every year you have somebody else in there paying on the house. They're going to give you basically $5,000 because they're paying off your mortgage. That means your investment of 60,000 is growing by 5,000 per year just by paying off the loan. That's it. That's an 8.3% increase year over year. What's the S&P doing?
7 to 10, 7
to 10, somewhere in there. So you're right in there. Yeah. You're keeping up with the S&P, and you have an asset in hand just by somebody else paying off the mortgage, right? So we also live in an inflationary environment. We've talked a little bit about it. You know, the Fed's going to say we're somewhere right around closer to 4%. We're about 12. Let's just be honest. People's cost of living is going up quite higher than that. We'll talk about that here in a second. So because of that, our homes are appreciating. What are homes appreciating at right now nationally? What's Case-Shiller, CoreLogic, Black Knight? What are they saying?
4%?
higher.
They're saying they said about 6.7.
Okay.
So this is my job to study that crap. Your job is to look sexy. So far we're both doing it. So we've got 6.7%. We're going to beat the hell out of this and say it's 2.5%. What's 2.5%? If you can consistently do 2.5% appreciation on a house, pretty reasonable, right, Greg?
Yeah. Oh yeah.
So what's 2.5% of 200,000, Pablo?
2.5% of 200,000 is 5,000.
5,000. So that's what percentage of 60,000? We had that number before. 8.3%. That's 16.6% is what you're making on your investment of 60 grand, just by having somebody else pay off your mortgage and by an appreciation of 2.5%. Both things are easily achievable if you get the right team, the right asset, and in the right area. Very achievable. 16.6%, and that's not even cash flow yet. So let's get into the cash flow piece of it. So we're talking about cash flow. We said there's $100 a month. You're running it for $1,800 a month, making $100 a month cash flow. Let's say, again, Black Knight, Case Shiller, about 6 to 6.5% is what's rents going up by across the country. Let's cut it in half. Let's say it's 3%. What's 3% of $1,800?
3%. I don't know, man. You gotta help me out.
You're doing really good. It's $54.
It's $54. That's what I was gonna say. I was just too busy chatting. And
you were starting to doubt yourself. You were actually the closest without going over as Price is Right rules. I heard you say 53. So $54. Not sexy. Does anybody excited about $54? No, that's not a great increase. What the best part of who doesn't get excited is the tenant. Your tenant is not going to walk out because you raised the rent by $54 the next year. They're going to go to dinner with their brother-in-law and pound their chest and say, I'm in a 3-bedroom, 2-bath. My rent went up by $50. You're in a 2-bedroom apartment and yours went up by 120. Who's the badass? And they're going to pound their chest and put it right in his face. They're not going to leave. In fact, they're probably going to take better care of your house. But what percentage did your cash flow go up by? You had $100 a month cash flow year one. Now it's 154. What percentage did it go up by?
54%.
54%. The easiest math of the entire day. It's actually probably the
easiest math
trickiest
of the
one
day,
for most
man.
people.
Yeah.
That's the trick question for most folks. So 54% increase. You're getting double-digit increases in your rent just by raising it a single digit. Now you're seeing huge growth, but this is where it gets unbelievably awesome. Now let's talk about inflation for a second. Here I'm holding in my hand right here, guys, is a $20 gold piece from 1888. $20 is what this was meant for. You. Maybe you can see it on there. It's $20. You could walk into a department store from 1920s, the 1800s, 1920s, and buy a hat, a suit, a tie, a shirt, a belt, a pair of socks, and a pair of shoes for that $20 gold piece. Now, today, what can I buy with $20? Let me share with something.
The socks.
No,
Yeah.
You can't even do that. These are the socks I'm wearing right now. They cost me $65 for 3 pairs. The reason I buy and I spend that kind of money on socks, I'm wearing I've had the same 10 pairs for 4 years. I don't have to have that problem, right? But here's what's crazy. I can't even buy the damn socks. But what I could do is buy every single one of those things I said with an ounce of gold. The gold did not become more valuable. The clothes did not become more expensive. The dollar became worth less. Significantly less because we're printing too damn much of it. Here's another illustration. Go all the way back to 1994. I don't know where you guys were in 94. I was 18, 19 years old. I walked into my first Taco Bell in Moses Lake, Washington. They had a value menu. I ordered 2 crunchy tacos, 2 bean burritos, and a drink for $1.99. Now, fast forward to 2023. I'm driving through a Taco Bell drive-through in November of 2023 with my 17-year-old. She ordered those exact same things. How much do you think I paid?
$7.
Teen. I paid $15 freaking dollars. That's a 750% increase in the cost of burrito construction. That's what has happened. Now, is it because burritos are more expensive? Because they're using better meat? Because they're having this hybrid? No, it's because that's inflation. The dollar's lost that much value. So why is this a big thing for us to talk about? Pablo, you downloaded an app earlier called the QJO investment tool. I need you to get that thing out. I know you didn't want to get your calculator out, but you got to get it out this time. We're going to do some quick math. Have any of you guys heard of what's called the inflation-induced debt destruction has been coined by one guy, or the 30-year fixed is a hedge against inflation? You guys ever heard that?
We talk about hedging against inflation and inflation profiting all the time, never to this detail and so well explained.
Well, we're going to get deeper into details here. I was theorizing on a podcast years ago. It's like, what does a person really pay when you're paying a 30-year fixed mortgage? Because I know the dollar's worth less every year, but what do you really pay over 30 years? And as I was theorizing about this, we never came to a conclusion because, I cheated my ass off to get that C in math. I got really good at picking locks. I did not do math really well in school, but I had and I'm sorry, Lee, there is no app there is an app for Android. There's just a problem with it right now. We're trying to get it fixed. But as I was theorizing about this, I got a call from the professor of accounting at Kennesaw State University. The university invited me to come speak to the students. And from there, they created a tool where I could actually do the math. And then I had it created into an app for you. So if you download that calculator and you click on the third one called the mortgage amortization schedule, let's put in there 25% down payment. We'll do a purchase price of $200,000. And we're going to actually beat it up and we're going to say 7.5 rate, which is much higher than what we're doing these days. We're doing just to show you exactly how powerful inflation is when it works for you, not against you. So, Pablo, have you done that?
I don't have my phone on me, so I wasn't able to download.
So he's being okay. So he's being the guy who's being the good guy about this whole thing. I'm going to set my phone down. I'm going to be engaged. Aaron Chapman, you be the guy on Instagram.
I got to be able to keep up with you, man. It's not easy.
So what we have here, anybody who's downloaded this, you can go to that third calculator called the amortization tool. You're going to click on that and you're going to be able to type in 25 for your percentage down, 200 for your purchase price, 7.5 for your interest rate. Again, being higher than what the actual rates are, we're going to talk about later. And you're going to find that your payment you're going to make is $1,048.82 per month. Now, over 30 years, because you can go to the upper right-hand corner, there's a calendar icon. You'll click on that. You'll swipe hard to the right to 2053, and you're going to save and close, and you're going to find you're going to pay $377,575.83. That's what you're going to see on there. But the inflation-adjusted payment, when you recalculate the dollar every time it leaves your hands, over the next 30 years, it's losing a little bit of its value, a little bit of its value, a little bit of its value. You're going to find that you only paid $142,937. You paid less than what you borrowed of your tenants' money. So I'm going to encourage you, those who listen to Dave Ramsey, brilliant man, don't listen to him when he says pay off your mortgage. Pay off everything else, though. Don't carry debt on anything else. This is the greatest asset in your arsenal is the loan. Now, when you're talking about paying extra on your mortgage, don't do that. Put it somewhere else. Prep it up to reinvest. Call JWB for another house. Don't pay down your mortgages. Why? Because the longer you take to pay, the less you actually pay, and the more you get to keep while it's worth more. Have you ever noticed how often the average person refinances their primary residence?
Every 7 to 10 years, maybe?
Actually, every 4 to 6. Now, do you know why that's a thing? Because the interest rates went down, right?
Right.
People think because the rates went down. Well, maybe it's a good thing. My banker always told me that the rates are better. Do it when the rates drop to this. My dad always said to do this. What does the amortization table look like on a mortgage for the first 5 years?
Not great in your favor.
It's almost all interest. So if you've got a community of people that believe the interest rates are the most valuable thing in your deal and that you need to focus on the interest rate on your mortgage, you end up getting them to continue to force these people to keep refinancing while you're paying most of the interest. So I have a case study I had with a client of mine where we had a $120,000 mortgage. He came to us at a certain point and says, I need to refinance. And I encourage them, don't do it just for rate. Let's say you have an 8% and it's now 2%. Well, hell. Do it so you can put, I got 2% on my headstone. You want it for just to pound your chest. That's about the only reason. So, but in his situation, it's about 1.5 points. He goes, that's the level I was always taught by my dad, by my banker, and my banker's retired. So this is what we're doing. He pretty much forced us. Now, he'd been paying on it for 47 months. By the time he was getting ready to close, he had paid this 48th payment, and he had paid almost $38,000 in payments over 48 months. His balance was 120. It had dropped by $6,200 approximately. Well, the loan between the lender fees, title fees, and the appraisal and the taxes and insurance, he had an additional $6,000 in fees he tacked onto his loan. His new loan was $119,880 some odd dollars. He was $106 away from his original balance, and he restarted his payment. If he kept doing this, he paid out $38,000 by the time it was all said and done, plus more costs in payments, plus the new costs. So he's at $44,000 in expenses. He's essentially at the exact same mortgage. If he stayed at that specific pattern for 20 years, he'll have paid almost $200,000 on his loan and never affected the balance. That's why interest rates are so important to you, because you're conditioned to think it's important to you. My job is to help you use that to benefit you as a real estate investor, to become more of a person who understands where real estate value is. And it's in the leverage, because you can leverage the growth of multiple assets and never pay cash for a mortgage, for a house that you're not going to mortgage and pull money back out, because you're only making the cash flow percentage, not all the other things. So let's open this up for any sort of thought process, questions, things that are bouncing around your guys' heads.
GC, I'll kick it to you, man. This is, we talk a lot about the 5 profit centers of rental property investment being cash flow, home price appreciation, tax savings, debt pay down, and inflation hedging. And this was like the most focus we've ever had on it. You, as somebody that owns 300 properties, manages 6,000 properties for almost 2,000 investors, man, what dawned on you in this explanation?
I'm just, Pablo, in the course of doing the show with you over the last 5 years, we continue to have these milestones where I just sit back, you just see this smile on my face as, something is being said. And sometimes it's somebody in our community who is talking about a lesson that we have taught. Maybe a complex, complicated lesson that over time we've continued to beat the drum, and then it takes its form in the form of one of our community members. And today it takes the form in Aaron's thoughts, right? One of our lenders, one of the teammates here at JWB that put this entire investment together. I hope you guys can see how it's not just Greg and Pablo who think different here, right? It's not just Greg and Pablo who are not your average investors. It's everybody in the JWB network thinks a little bit differently than what you might read on, CNN, Fox News, CNBC, whatever it is, right? And the beautiful thing is that this whole time we are understanding just how powerful the other profit centers are in addition to cash flow. And cash flow is great. Nobody's going to say we don't want cash flow. But what I'm sitting here just smiling and reflecting on is how beautiful it is to hear somebody eloquently talk and share real numbers with everybody about how impactful and powerful the other profit centers are. I mean, basically, everybody comes up with this reason that maybe cash flow isn't enough. Maybe that's the reason to sit on the sidelines. Maybe interest rates are the reason to sit on the sidelines. And what Aaron is showing you here is that none of that stuff matters. What matters is getting the asset in your portfolio, letting it grow, and then using debt, using leverage as a tool. That truly is how the wealthy become wealthy. That's how self-made folks become wealthy. It's the easiest tool to pull and to master. So I am just stoked that it's not me sharing this right now. It's Aaron. And I see the folks in the chat and everybody's like, yeah, I get that. No, I know that. I was watching somebody who just chatted and said, well, I'm excited about 54 because I know what 54 is going to grow to over time. Like, this is such a well-educated audience. And Aaron, I think you did a great job sharing it.
I think one of the things that all this does, I gave you data upon data upon data upon data, just to put a bigger smile on his face and say, I already do all this. Now I know I'm doing it right. I don't have to have a specific magic, whatever thing to accomplish it. It's a long, trudged out process, but you guys are doing it right. What the risks that you have is when you have somebody who wants to lead you down the path away from these principles, these ideas. Most of the time when somebody's leading, it's for 2 reasons. One, it's either ignorance, or it could be some malicious thought that they need to, they can generate revenue from yourselves. Unfortunately, we have a lot of that in the market. I swim in an ocean of predators in the lending space. It's one of these scenarios where they need to close another deal. They got to get paid, and they're going to be taught all these different ways to sell things so they can get paid. And I get that and I understand that. But the bottom line we have for us is we need to make sure you as a real estate investor are successful. I focus on deal number 12. It's great to get you closed on number 1, 2, and 5, and 9. But if I get you to 12, your life changes at 12. JWB changes at 12. I change at 12. Everybody changes at 12. Anybody can get you 1, 2, or 3, but can we get you to 12? That's where I believe that we need to have all our focus for every single person. And if we hose you over on deal 1, 3, 5, or 6, you're not getting to 12. You're walking away and you're moving somewhere else. I need you to be successful. I need you to get to 12. If you start to fail, we will all start to fail. And I violently oppose failure. So one of the things about our industry right now, the average person is doing 1 to 2 transactions a month. That's, that you could be, if you're working with them, 50 to 100% of their income that month. And if you run into a scenario on the house, I'm like, I'm not sure about this. Should I really be doing this? I don't know if I want to do this deal. And I just had this conversation with Aaron and Greg and Pablo, and maybe I shouldn't refinance my house for the interest rate right now, but you call him. What's he going to tell you? You're a 50% to 100% of his income that month. He's probably not going to give you the straight skinny on what you should be thinking. Myself, you may be 1/60th of my income that month. And I'm not trying to say that you're not important. What I am trying to say is I'm not concerned about that one deal. We'll talk in real time about that deal, whether or not it makes sense. I'm concerned about the deal 11 down the road. And I got to be sure you're successful on that one so we can make sure that you're successful for number 12. That's the main thing here. So applying all the principles that we talked about here, putting all that to work, everybody should be really, really happy with what you've done so far in your existence. Now, there's different levels of this. And I don't know how much time we have here to get deeper in this. There's other things that we like to do. I've been investing in real estate since 2001. I lost all my real estate in 2008. I got in a motorcycle accident, August 8th of 2008. I went in that, I left my house that morning, 190 pounds, a marathoner, a rock climber, jumping on a Harley. I had a net worth about 3.5 million. I found myself in a hospital that night. Memory was wiped. I ended up leaving there at 154 pounds with a negative net worth of 1.5 million. I started over an industry as obliterated to the next real estate investor that walked into Arizona in late 2009 and rebuilt my business to where I sit today. Now we're ranked in the top 20 in the United States in what we do. And the whole goal is just to focus on the real estate investor. So ultimately, we've taken it from that to now investing in 6 states. I've got a family trust. I've got each one member of my family that's married. I have 3 married kids, 2 grandchildren. My youngest just became an adult in the last 3 days. And they live in houses bought by the family trust. They lease back from the trust. I lease from the trust. My cars are in my trust. I lease for my cars from myself. There's ways that people can do this to make sure that they are all 100% protected and built and structured for themselves and for their future. That's where we focus our time and energy.
Woo, let's go, Aaron. I love it, man. I love the perspective. I love that there's levels to this game. I think the enduring thing here is, number one, thinking long-term, right? In your relationships, in your actions, and the way that you're planning for retirement and the secure financial future. And then the other piece is the idea of that fits really nicely with building an army of income producing rental properties that over time, growing cash flow, beat inflation, appreciate. We love all the 5 profit centers. We love the idea that when you leverage the home price appreciation is the thing that brings you the most wealth and the most options. And I find that most real estate investors get to that point, right? They might be at that 1, 2, 3, 4, and they look for a partner. They look for somewhere that they can get to that 12, right? And that is where Greg's team at JWB really, really shines. And we want to share with your audience, after you've shared all your wisdom, kind of the way that our community goes about it, right? Because Greg and his team have pioneered this way of making this super, super passive, being a mile deep and an inch wide in one of the most attractive markets in America, and just be able to do this for everybody. So GC, are you ready to just kind of share the beauty of Jacksonville and like all the good stuff, that it's not just one of the hottest markets, but it's still one of the most underpriced markets, and how to get into it?
You know I am, baby.
Let's go, big boy.
So for everybody who would like to, take this home with them, the slides, we always make that available for everybody on our show. If you guys would like these slides as we go through them, you can just text our team. This is Miss Tiara on our team. You can text her at 904-293-0341. It's a real text. It's a real person. So you can just ask her questions. She's right here in the office, and she is a wonderful resource to receive these slides. Or if you have any other questions, or you want to jump on the phone with JWB, please reach out to Tiara with the number right there. So, I have had the opportunity to invest in real estate for 18 years, and I've traveled the country, and I've spoken in pretty much every state out there. I've spoken with thousands upon thousands upon thousands of investors, and I have access to the data to know how each of these markets is performing. And so I've been really able to zone in and understand why investing in Jacksonville is such a smart move, not just for one profit center, not just for 2 of them, but for all 5 profit centers. Because as a real estate investor, what you want to do is you want to take this information that Aaron's sharing and that we're talking about here today and put it into action, and know you're in a market where you get all the benefit from all 5 profit centers. You want to make sure that it's growing from a cash flow perspective, tax savings, principal pay down, but also it's growing because the market is what it is and people are moving there. And so I did want to share with all of you. Obviously, I'm biased. I've invested all of my rental properties, which I own over 400 rental properties. They're all here in Jacksonville. My business is in Jacksonville. So you probably expect that I'm going to be biased. But I'm going to give you some numbers here that might surprise you. Jacksonville, Florida is the only real estate market in the country with prices that are below the U.S. median, rent price growth above the U.S. average, home price growth above the U.S. average, and population growth above 2% in the last 5 years. It is the only market in the country. Aaron, do you know that?
I did not know that one.
Most people don't. Most people
I'm
don't.
a generalization guy. You guys getting that targeted, like you said, an inch wide and a mile deep.
So and again, only all the markets in the country, this is the only one that can claim that. So what you get with these four things are low prices, you get rents that are growing, you get home prices that are growing, you get people moving there. That is a recipe for above average return on investment and risk mitigation. Risk mitigation, because people are moving there. That's demand for housing, both in the form of rent price appreciation and home price appreciation. So our prices are 13% below the median. We have the fastest growing median income of any major city in Florida. We have the fastest growing population of any major city in Florida. And our population here has grown over 5 times faster than the US over the past 5 years. Pablo, how fired up were you when I put these stats together? Have you stopped smiling?
No, man, I love these stats. I think it's such a beautiful snapshot of upside that is still there waiting for me. And this idea of like, I'm also getting a deal. Right. So like I love that part. I like to compare this to like if somebody gave me the tip on investing on Apple, like after the iPad is very different than if they gave me that tip like right when the iPod came out and the iPhone was still to come and the iPad was still to come, because there's just all these like great signals that this is going to keep doing what it's doing.
Yeah, and it's kind of like what Aaron said early on. If you knew that somebody was about to move a bunch of money into a certain asset or stock and you picked up a big tip there, then you might go and you might buy that stock. Well, think about it in terms of what drives home prices and rent prices to go up in real estate. It's people moving there. So if you were like sitting down at a table and you saw 5 times the amount of people that moved anywhere else, all of a sudden just start moving to Jacksonville, you'd be like, well, where are they going to live? That's probably going to increase home prices and rent prices. I probably want to own something there because that is a thriving economy and people want to go there. So now we understand big picture why rental property investing is so critical. We understand how those profit centers, maybe even the ones you didn't really understand, how they work now. Now it's about taking action and putting in the right spot. And that's where Jacksonville comes in. But I'm not the only one who loves Jacksonville, right? There are other well-respected publications. And Pablo, I think you fell in love with this report from the Urban Land Institute, didn't you?
I did, man. As a young professional growing up in the construction game and married to a landscape architect, this ULI, Urban Land Institute, is kind of like the association that tells you like what cities are working and what is doing really, really well. And seeing that ULI put Jacksonville in this like list of supernova cities with Austin, Nashville, Raleigh-Durham, Boise, and Jacksonville is just like one of these things of, man, I don't think anybody else in America had Jacksonville in the same kind of like frame as all these like super sexy cities that everybody wishes that they would have been investing in for a long time.
Yeah, it's almost like which one of those doesn't feel like it belongs? It's probably Jacksonville, right? Austin, Nashville, Raleigh, Boise all have very thriving downtowns, have very strong tech hubs or education hubs or manufacturing hubs, right? And they've been on the front page of the most successful cities really for the last at least 5 years. But Jacksonville's really been under the radar. So when the ULI named Jacksonville one of the 5 supernova real estate markets, it really matters. A lot of folks and businesses that are thinking about making investments look at this report. And then just think about it from a second as well. If you're thinking about where you want your money to grow, look at how they named kind of the big brackets here, right? The supernova cities are part of a bigger bracket called magnets. That means that's attracting where people are going, right? If I'm going to think about where I want to put my money, putting my money in a place that's called a magnet or a supernova just feels really good, right? They didn't miss with the nomenclature of what they were calling these places. And then you look at some of the other places that they've named here. It's the establishment or the backbone, right? Does that really sound like that's where your growth is going to, your biggest wealth pie is going to be created in the backbone? No. And you look at some of those cities there, which I love some of those cities, but probably not thinking of the next big thing when you think about some of those cities on the list.
Makes sense, GC. So this is already ULI calling it a supernova city. All these other cities that we're put in there have had this like explosive growth. So has Jacksonville. But I know that we're here to kind of give out this like behind the scenes, a mile deep, an inch wide thing, right? So like give us the insider information that tells us that Jacksonville has a long way to go as far as continuing to be a supernova.
Yeah, absolutely. So I was super pumped when Jacksonville made that list. But then my next question is, okay, what's different about Jacksonville than those other supernova cities? Why not invest in those 5 supernova cities or those other 4? What makes Jacksonville different? And there's one that is just completely easily understood right off the bat. I listed here the median home sales prices of those 5 supernova cities, along with median income and population growth. But let's focus on median home prices first. Aaron, what's the biggest thing that jumps out to you about median home prices in those 5 supernova cities?
Seeing nearly $100,000 swing, if not more, to any other city out there.
Exactly.
That's significant. That is a significant difference.
Yep. Jacksonville's home prices, the median home sales prices are under $367,000. These other home prices in these other markets, they've already blown up. They've already been on the front page of all of these wonderful publications here. Boise's at $491, Austin's at $457, Raleigh-Durham's at $501,000, Nashville's at $489. So you have an opportunity to be the most supernova-ish of the supernova cities by investing in Jacksonville, which still hasn't caught up with home prices with the rest of the country and especially those supernova cities. And I also wanted to point out,
it's even below the national average, which is also significant. National average is 432,000. Look at that. You have a supernova city that is that much lower. Was that 70 some odd $1,000 lower? Actually, probably 70,000 lower than the average in the United States. That's a significant thing to consider. And if people aren't looking at that really closely, you're not paying attention.
And that goes back to the facts that I shared earlier on, why Jacksonville truly is the only market with those 4 characteristics. It's hard to be above and rent price growth and population growth and home price growth and be below the national median for home prices. It's just really hard to do. And Aaron, you brought up a great point. Not only are we the lowest of the supernova cities, we're lower than the average city in America.
Huge. Absolutely huge. And one of the other things to point out to folks, and maybe we're going to get into it, maybe we're not, is like, I know you guys are talking about, these other factors in the cities, but know who else we're trying to get ahead of? We're trying to get ahead of the major corporations, the hedge funds. They bought 44% of the single family houses last year, 2023. They're on track to do the same. They're on track to control 60% of the single family housing by 2030. If you're sitting on the sidelines waiting for something later, you're giving them an opportunity to take the opportunity from you. Don't sit there and wait.
Well, we could do a whole show on the institutional activity there. I think, our time is probably coming shorter than we want. So I'll let that comment just marinate out there. But I think the point is here, we understand that it's really not about the interest. We have great interest rate news right now. So I love it. And I like riding that train because it helps people. It gets easier for them to jump in the party and own rental real estate. But the reality is, I've been saying this for a long time. We've sold hundreds and hundreds and hundreds of homes to our community members here while interest rates were 6%, 7% higher. And it's because our community, Aaron's community, we understand that's not really even just about the interest rate. It's about buying an income producing asset that grows over time, having a wonderful team to manage it for you and holding on for a full market cycle. Aaron, how many people do you know that have owned real estate for 10 plus years tell you, hey, listen, yeah, that was a real dud. It really didn't work out well. Have you ever heard that?
Not from people that have held it that long or people that have stayed active in it. People that may have bought one on a whim and didn't do anything and didn't do the right things. I might hear them say, I made the bad move. But staying active, continue to move, build your portfolio, understand what you're buying. There's not a single soul that I have talked to that has been in a bad spot with real estate. They've actually done nothing but thank the Lord they made that move.
100%. We've had the pleasure of serving over 1,700 clients that invest in Jacksonville with us. Many never come to Jacksonville. Unfortunately, I never get to shake their hand because we've built this to be passive and they don't have to come here. And we've generated over $300 million in profits just following this process. It's the boring, get rich slow process of single family rental properties. Everybody needs to think they need to find something brand new, shiny, or the newest, latest thing. It's all around you. It's single family rental properties. It's treating your residents really, really well and holding on to this asset over time. And that's how you can become independently wealthy.
I fully agree with this idea of boring rental properties and going in, and I'm all in on them. But GC, I am somebody that likes shiny things. So I want to tell people a little bit about kind of like what we're super pumped about. This whole thing that I teased, the Apple iPod, right? Like this is not fully cooked yet. It's this idea that out of all those cities that we mentioned have these revitalized downtowns. And you found this great statistic around how revitalized downtown cities appreciate 23% more than the US over 2020. So what I want to do is tease this for, I want those of you that haven't seen this report to text JWB at 904-293-0341, because Greg has done this comparison of those other supernova cities, how it went when the revitalized downtown happens. And then here's the key metric that you want to know about before you understand just how easy it is to invest in Jacksonville. It's the idea that when downtowns hit 10,000 residents inside that density of like the urban center, developer incentives now go away and the flywheel has begun. It becomes a lot easier to make it a thriving place to work, live, and play because great downtowns have mixed use developments in them. A great mixed use development needs an anchor tenant, like a Whole Foods or something like that. And these great anchor tenants look for that number of 10,000. So as soon as that tips, now these things keep going. The downtown becomes this like hot place to live, and the city appreciates 23% more than it had been appreciating prior to that happening. Jacksonville has for a very, very long time floated around 3,000 residents. And very recently, in the last 10 years, they've gotten very, very deliberate about this push for downtown. And you see it in these statistics, right? It's gone from 4,800 to 5,200 to 6,100 to 6,800 to now in 2023 and 2024, it's already projected to cross that $10,000 metric. You see it, again, more great stats from GC, but you also see it in the numbers being poured in. So this is right now happening. This is the behind the scenes stuff that unless you're a mile deep and know this, and oh, by the way, JWB is one of the companies that has purchased 20 city blocks in downtown, is doing one of the major developments in there. And they're doing it with this long-term mindset of knowing that if downtown really happens the way that it's supposed to, and you place make, not just build for rich people, that all the surrounding homes around it go up accordingly. So this is the thing that to me is the shiny thing that doesn't have to do with interest rates. Is this like once in a generation inflection point that happens in a city that everybody looks back and says, oh man, I saw that coming and I just didn't have the stones to like put my chips in the table, which I think is what's really, really interesting here in downtown Jacksonville. Anything you want to add to that? Aaron, have you heard of any of those stats of like downtown renaissances and like how that's happening in Jacksonville?
A little that I get to know on those those really, really focused levels. And I work so much in the national space. I've been working with investors all over the country, and we'll do, sometimes 1,500 transactions a year for real estate investors, which shows we're, this is where the person should be. That's exciting stuff to understand because I've seen what happens in these downtowns. And that you guys are getting, it's almost like you said in here, almost like insider trading, to know these things as it's starting to happen. And you're already in the space. You're already talking to the people who'll be able to give you the opportunity in there. It's like knowing about the market back in 2008.
Having the answers to the test ahead of it is how GC likes to call it. GC,
There
you want to tell people a little bit about how you help them benefit from all this?
Yeah, absolutely. So, we started out building this business 18 years ago, and the whole premise was this, is that people know that you can make money in real estate. It's been pretty documented that there's more wealthy Americans through real estate than any other asset class. It's available to everybody. You don't have to have a certain job or a certain, degree or a certain amount of money to get into real estate. So that was pretty well known. But what was preventing most Americans from getting into real estate and rental property investing is worrying about the experience, being a landlord. So we built this business to make it easy for everyday Americans to invest in this beautiful asset class, which is single family rental properties. And so that's what my team is able to do. I would love to welcome Aaron's community here to, of course, be a part of the Not Your Average Investor community. We have loved you guys being here. You guys can continue to be a part of our show and our community. It's just a incredibly warm and inviting place. So we would certainly welcome you here. And we'd welcome you to learn more about JWB as well. You can text Tiara is a great way just to kind of get involved. There's her number again, 904-293-0341, and learn about investing with us, because we work with clients in almost every state. We have clients in 13 countries, and we manage $1.3 billion in real estate assets for everyday investors. They're not institutions, everyday investors, just like the three of us. And we'd love to serve you as well. So a common question we get is, should I invest now or wait? As you can tell, guys, home prices are expected to go up, contrary to what you may read in the media, in the news. If you understand the relationship between interest rates going down and asset values going up, you'll understand that home prices are likely going to go up, and the cost of sitting on the sideline and waiting is substantial. I'd estimate $30,000 to $40,000 of opportunity cost just simply by waiting a year to invest in Jacksonville properties. So if you're curious about it, get on the phone with us. But I did want to leave everybody with just what it looks like to invest in a currently available JWB property. We obviously have more to share with you about this if you reach out to us. But just at a high level, your purchase price is somewhere around $225. It's very normal. I would say about $180 on the low end, about $280 on the high end, which I wasn't tripping over my words there, right? Median home sales price in the US, somewhere around $430. You're able to buy assets here in Jacksonville somewhere around $225,000. Brand new construction is something we specialize in. We build hundreds and hundreds of homes each year, and we have them as rental properties, and we work with great residents, renters, or tenants, you may call them, and they rent the homes with us. We put this all together, and then we sell this to you as the investor, almost put it on a silver platter for you, and it's completely passive. And the beautiful thing is that we do all the management for you. We're a vertically integrated company. So the same company that's selling you the asset is the same company that's collecting the rent. And over time, we're able to create incredible profits for clients, and we hope you can join us here. Some portfolio highlights: minimum investment per property is going to be somewhere around $50,000 to maybe $75,000, which is really wonderful. With the interest rates coming down as they have, that has lowered the down payment requirement in order to be positive cash flow. And whereas it was about $75,000 to $100,000 to buy an asset, now it's about $50,000 to $75,000. So a big win there. Your estimated rates of return are going to be somewhere between 10 to 11% on average. And we've had recent clients closing their interest rates at just under 5% interest rates, which is super wonderful. We love that. It's not the only reason to invest, but we certainly love that. And if you're interested in investing with JWB, we do have multiple incentive packages that are currently available. Like, for example, we're going to cover your first $4,000 to $6,000 of your maintenance costs per property that you acquire right now. We've continued to extend that incentive as interest rates have been higher than we all wanted, and we're still keeping it right now. I don't know how long we're going to keep it, but that is certainly something that's available. And Pobbs, why don't you talk about the community and invite everybody? What do you think about it? Do you think they should join?
Oh, man, it's like GC said, it's a very welcoming place. We do this every Tuesday. We hang out each other at events around the country. It's completely changed my life to be surrounded by a whole bunch of real estate investors, right? Because I think Charity just joined our WhatsApp chat thread. And it's like, when you start getting really pumped up about real estate, it's easy to get pumped up, right? It is the thing that builds wealth for Americans. It is the spine of the American dream. And yet the moment you talk to somebody that hasn't had the foresight, the understanding that you got to do things a little bit differently to do it for yourself, you're going to get all this gravity around you pulling you down, right? Like, people just like, oh, are you sure? Because I don't know, because I've never listened to Aaron Chapman speak, right? So this idea of being surrounded by a community full of generous people that get together every Tuesday, share phone numbers, share insights, and have become true friends has really been probably the proudest thing that I've been a part of professionally, for sure. So invite you all to come on Tuesdays and join us live, or check out the podcast, right? If you just search Not Your Average Investor Show on YouTube or on any of your podcast platforms, you're going to hear me start off with a goofy intro, and we'll go from there. You'll be invited in. So guys, we're a little bit over time. Aaron, what'd you think of, like you said, you're a national guy. You've probably got assets around different places, man. What are you thinking of, these insights around downtown and future growth and generally the completely done for you vertically integrated turnkey model, man? Is that something that you've been a part of before?
For a very, very long time in multiple different markets. But one of the things I could speak to in our partnership with JWB, since we've been able to form that partnership in the last little while, is the the mirroring that I would say within your guys' organization to my own, we are very, very big into process procedures and have it built like going to Chipotle to get a burrito, right? You have a different person at different stages of it. Now, some people get frustrated. I'm not dealing with one person all the time, but there's more efficiencies and accuracy in dealing with a different person to construct that burrito out. And we do that on the lending side to make sure that things are accurate, they're efficient, they're quick. JWB does that on the real estate side, and mirroring those two systems together, to me and my team, was one of the greatest merges we've ever had in the industry. So we appreciate your team. We appreciate what is being done over there. We definitely love the real estate. We've had less issues when it comes to the finalization of the deal, when you're getting in the data on the property, because we're going to do that pre-qual well in advance. And anybody doing a pre-qual with us, when you go to my website and you go to aaronchapman.com and you click on that apply now and you start moving through that, we're going to take you through a little bit deeper dive. We're not going to be, hey, let's look at a pay stub and a credit report and send you a letter. No, you're talking to an underwriter on the front end. They're looking at they're going to run a cash flow analysis on your business if you're self-employed. We're going to really figure out what you can qualify for and how many. And we're going to interact with your team at JWB, which is, again, your team. And as a result of that, you will have that experience that I don't see investors having very often, an experience of true professionals that know what they're doing, that have a great asset with a great outcome and a managed business at the tail end. You literally, anybody sitting here as an investor is a CEO of an investment firm. You've got a lending arm, you've got an asset arm. You have a complete business strategy that's all turnkey done for you. All you do is sit your ass in the seat and do the application. That's it. That's all you got to do. And then follow instruction till the end.
There you go. Sit your ass in the seat, do the application, follow instructions, build wealth, repeat. That's what we've been saying, man. What do you think, GC?
I love it, man. It's just so simple when he says it. I just want to listen to you all day, every day.
Yeah, I love it. I'm pumped up. Listen, we're a little bit over. We never take it for granted that you took an hour out of the middle of a workday to hang out with us. Come get educated. Come get connected. For those of you in Aaron's community that are part of this for the first time, would love to invite you to Tuesday's show. We're talking about Robert Kiyosaki, a little guy you may have heard of, has a new update on what he sees as attractive in the real estate market. So we're going to beat that up and talk about that on Tuesday. Hope that you come by. Text Tiara to what's the phone number, GC? You know it by heart?
Yeah, it starts with the area code 904-293-0341.
Yeah, download that report. Super interesting. Get Aaron's, what is it? JOC. What's the acronym, Aaron, for your app?
QJO Investment Tool. QJO Investment Tool.
QJO Investment Tool. I'm going to be downloading that and QJOing myself. It's going to be a lot of fun. Look at my numbers, and hope that you get comfortable here with us in our community, Aaron. I'm sure that we're going to have you back, man, because it just makes way too much sense. It's way too much fun. And from now till next Tuesday at GC, we like to leave our shows with one little bit of advice for everybody. You ready? Don't be average. All right. See you later. Thanks, Aaron. Appreciate you, man.
You guys, appreciate you. Thanks, everybody, for listening. Pay attention.